Well, good day, all. Ira Epstein, and here we are, Friday night, November 3rd, 2023, with your weekend edition of your financial market wrap-up. And this wrap-up is for Friday, the 3rd of November, 2023. Okay, I am not going to be live on any of these, in other words, in my studio, being able to record with my weatherman and all that, Monday through Thursday, doing some personal things. So I'll be gone. I'll be back Friday. Okay. This was planned because I wanted to leave after we had the 4 central banks come out with their monetary policy decisions, see the jobs report. And then I figured, okay, I can leave and I'll be here for Thanksgiving. I'll be here for Christmas. I'll be here well into January. So this is my few days off. All right. I'm a workaholic and I enjoy working, but my wife's demanding I go with her. So where are we? Well, there's a rule called the SAM rule. I don't know if you know it. Google it, SAHM. And it talks about when you get up a half a percentage point, let's assume that we're running 3.4% was the low. I'm making this up for you, okay? 3.4% low on unemployment, and the market goes up to 3.9. Well, some people would say, well, there's the 5 points on the SAM rule, which means you're going into a recession. Number one, it isn't 5 points. It's a 3-month moving average. So you've got more time to go. It never is within this short of a period of time. It's got to get it going and see it. And then the rule says that the SAM rule says that if you understand the theory, your unemployment's going up by a reasonable amount that forces the economy to weaken in its own way. When that weakening happens, the economy goes into a recession or certainly slows down rather sharply. Whether it's a full recession or not, you don't know. And often it's a lag effect. Just think, it's a 3-month moving average. So the lag effect will be there, and you may well have been in one. That is part of the rule. I just like bringing this stuff up because people will hang their hat on all kinds of things. Here's what we know. We know that the marketplace thinks the Fed is all done. There's going home tonight about a 20% probability of another rate hike this year. So it's now 80% no, you're not going to get one. I am in that camp too, because in looking at what's going on in the jobs data, even if we go back up and revise and we say we're at 200,000 with revisions, it's no longer the 300,000 numbers and the Fed would just pass on it. That's my belief. If inflation were popping dramatically higher, they might do something, but I haven't seen anything that shows that on the economic data. We'll wait and see. I'm just not seeing these things that are saying that. So I get it. So I think we look at the market as a form in an attempt at a transition from a bear market into just what I have been saying, end of the year rally. It's too soon to call it Santa Claus. Santa Claus rally is not in the month of November. It starts with that. It's the end of December into the beginning of January. It has expanded in the concept over the years, but that isn't the real meaning of it. It's the very, very end of December into the very beginning of January. Okay. So we should go to the charts, take a look, and see what we've got here. First off, the market has not been able to even get back under the 18-month moving average of closes. So the bias has stayed up this whole time. Number two, we are looking now on an area chart of just closes on a weekly basis of the S&P. We just broke through that. So this correction phase that began at 45.21 culminated near the 41.25 area. And here you are, and you finally got a settlement where you've broken that downtrend. The negative to what I'm saying, and have an open mind, please, is that you're not over the 18-week moving average of closes. You got to prove you can stay over that to get friendly. So I'm looking at this as an extended rally into resistance on a weekly basis. When we take a look at a weekly bar chart, your highest close here, actually the highest high on the week was 46.34.5. You dropped roughly 500 points, and you've had a heck of a bounce. Have we negated the downtrend in terms of the pattern of lower highs and lower lows? You have not. You still have that fully at work. I think you see that clear as can be. Number two, where did you hold? As we were breaking down, I was saying maybe you're going to hold that 100-week moving average of closes, the first test of it, and you most certainly did. Remember, when the market was underneath it, this was your resistance point. When a market gets over it and comes down, that point often flip-flops and for the moment becomes support. That's what happened. When you put the Bollinger Band with it, if you're a subscriber and you get my morning video for my subscribers, I was pointing this out. I'd been pointing it out. I said, I don't think you want to be short anymore. When did I start saying that? I actually started saying it here. Did I not put out for you a special report that said, I thought the week of October 24th was going to be the low in the market? Okay? Back over there on the daily charts, you've seen that. Well, it's not bad. I'm not too far off on what I was saying. So we've come down. Prove to me you can get up and stay over that. Then I'll say, okay, now we have broken the downtrend. This isn't breaking the downtrend on any piece of work I have. None. Yes, it could happen, but it hasn't happened is the important thing. The second part in the Dow, it's the same thing. You're either a chartist or you're not. Lower highs, lower lows. The big support was the 100-week average in the Bollinger Band, and you popped back. Okay, can anything here turn bullish? If you believed an uptrend would have higher lows and higher highs, no. You could end a downtrend and get an extension as traders panic and they're coming out of the markets, but no. I'd like to see the end of the bear trend. We all do better in uptrends, but I don't know that that's the case. We all do better for our own selves. Nothing like a good economy, not one that slows down. NASDAQ, you got to the band. What's my rule when you hit a Bollinger Band the first time? If you're not embedded, you're coming out. I teach this, my morning videos. I harp on them, harp on them, harp on them. And there's your rule. So I think the pros were out. But right now, guess what? You're still bearish. I know that sounds, people think I'm out of my mind. Remember what I'm saying. Take out the high up here and you break the pattern of lower highs, lower lows. Doing this? No. The pattern's still bearish. The bias turned up because you were able to close at 15,178 over the 18-week average, but that's not a buy. That's not a buy at all. I think some pros were selling it here today to see if you can get up that 300 points. Don't know, don't care. In the Russell, you still have an embedded reading. So the weakest of all the indices, and I was right in that analysis, has been here, and it's the one that should pop the most. Why? What type of company is most vulnerable to high interest rates, which means it gets the most benefit if rates drop? The Russell. It ain't doing it, folks. I wish it were, but it's not doing it. All right? And you're loaded with resistance. The 18, the 200, the 100. So, yes, if you get through the 180270, I have the argument that you've broken the downtrend, but I don't see how you get a buy signal out of this. In the 5-year notes, nice bounce, lost the bearish embedded reading. Market should go now to wherever the 18-week average comes in before you get back under these lows. This does not turn the trend up. It negates a downtrend. Same thing in the 10-year. You now have a lower low and a higher high, and you lost the embedded reading. Wonderful. So before you get under here, I think you're going there, and we fight a battle. Now, you have gone from 5% to about 4.6, 4.5, right in that range. It's nice to see that type of break in the market. It's going to help housing. It's going to help all the pressures on us that are tied to that. Is it fleeting or is it here to stay? That's going to be the big question that we're going to find out over the next couple of weeks. How did the dollar fare with it? Well, if you pull the rug out on interest rates, why should the dollar go up? Higher high, lower low, and take a look at your momentum here. You lost the bullish reading. So before you get up and over the most recent high here, right now, I'm looking for it to get back to the 18-week average and try to find its footing and see what's going to go on. Transition. Transition. That's what you've got. Transition going on. Eurocurrency. Transition. Coming over the 100-day average. getting its outside week up, lost its bearish embedded reading. I'm expecting a challenge now of the 18-week moving average of closes. And I see reasons for traders to have covered, past tense, on the close today, all their shorts in the euro, all their longs in the dollar, and on a weekly basis, they're neutral at this point. The Canadian dollar. The Canadian dollar is still in the bear camp. Now, is it embedding is the question. So follow me. We get 1 week where the market's got both numbers under 20, the week before under 20, but not the week before. On a weekly basis, an oversold market that's ready for a bounce, and that's about all that I could say about it. Again, if the market gets up and over 73, 76 and a half, okay, you finally break the pattern of lower highs, lower lows. Actually, this is the first high. Lower highs, lower lows, and you probably run into your buzzsaw at 74 cents in the market. But they too are starting to see employment wobbling, coming back down. Japanese yen, still a fully embedded reading. This is the week, this week, where I think the pros will try to sell the yen. They'll come out if they lose the embedded reading. But this week on a weekly chart, there's a number there. Those of you that are in my morning subscriber videos will be talking about that. I'll do it for the weekend and show you this number. I'll have that out tomorrow probably for you Saturday. Now, Bitcoin, overbought, up and over the Bollinger Band. So as bullish as I am, because I do believe we're going to see ETFs based on spot, as bullish as I am and a crossover of the 18-week average over the 100, I would never tell a client to buy over the Bollinger Band. End of discussion. You only stay over them 5% of the time. There'll be a way to come in on your terms. I don't think this is that. When we come to the Brent versus WTI oil, we're just sort of sitting at about $4.50 difference. Hasn't done anything. But I have been warning you every day that I'm not in love with oil. I keep saying, and dollar the same way, and gold the same way. Have to tell you, I realized that October 7th, Israel was attacked, but this is November 3rd. You can't keep discounting the same piece of information over and over and get the same result. I get that gold rallied on it. I get that oil rallied. I get the dollar rallied. But now we've seen maturity in the war. Maturity being lots of talk, lots of people threatening Hezbollah today, making veiled threats against the United States, reminding us very nicely that we had to run out of Afghanistan with our tail between the legs. They're right. We did. We don't fare well when we do those things. They're right. We don't have a stomach for ever-ending wars like, I have to tell you this, like the people in the Mideast. They enjoy, they thrive on these groups, never-ending wars. They carry it back to their biblical beginnings. This is it. Palestine is not for Jews. Jews are slaves. They belong as slaves. Maybe they should be gone. That has gone on forever, okay? We know the argument. We know what Hezbollah is about. We know what the other groups are about. But do I think that the member countries that they're residing in want to go into war? I don't. I think cooler heads not only have, but are going to continue to prevail. I think that Iran is smart. They will do their things through their groups. Russia will join in and try to stir up the pot because it takes Americans away from what's going on in Ukraine. They want us to spend all our money, rightfully, they're right on this. Spend all your money on Ukraine and Israel. Go on, guys. Spend it all. We're there. But what makes you think they're so strong? Okay, what makes you think they're going to be able to survive that? War is a never-ending bad machine. For all kinds of reasons. Okay, so as I look at it, I have trouble with that chart, okay? It's not bearish, but it's no longer bullish. That's the difference. If it gets underneath and you take out this low, you got a problem. Then you got lower highs, lower lows under the 18-week average, and you open the door for the lower Bollinger Band, and that'll climb next week. It's climbing to the tune recently, if we look at it, of about $2 a week. Now, Will it keep that? I don't know, but that means around the $79 level could be where the market gets into its support. I am certainly not in the bull camp at this point. You need to stay over these, certainly over the 18-week average, and you're not doing it. In WTI, it's bearish. Lower highs, lower lows. You're already in the bear camp. You're opening the door for down here. Momentum down, that down. You'd have to get back over 2 weeks ago's high to negate the downtrend, but nothing on this chart, as a chartist, turns the trend back up. That helps the U.S. economy again, and other economies around the world. These aren't bad things to see these prices fall. In heating oil, you're in your downtrend. Now, this is the time of year where heating oil often comes down. It has to do with tax spreading and how it's all working, and you're seeing the impact of that. And I know, and you're right, Ira, you're out of your mind. Why would it come down? We're going to be in winter. We're going to have snow. You just had it in Chicago. I know. But you were down for the week, $1.28, okay? Down 4%. So you can tell me all you want to tell me, but there's seasonality that fits into some of these trades that you pay attention. So you put it together. And what I want to do is be your guidepost with that. Now, what do I mean? In the mornings, for the futures at 5:10 in the morning, I'm recording. See what I'm saying here? There's a lot more that I don't tell you here. I'm telling my subscribers in my morning what I'm seeing, the different rules that I see. I've been around this 54 years. There's a lot that I know, and I share my knowledge. Then, everything I do is based on charts. No gut trading, none of that. Not interested in day trading. I'm not your day trade guy. Swing trading, longer term trades, I'm that type of guy. A swing trade could be a 2-3 day trade, okay? That's not a day trade. It could turn out to be longer. It works with it. But I talk to you technicals, fundamentals. My trade recommendations are specific as can be. If I have an open-ended stop, I would say, hey, be careful. I can't find one here if you're going to play that. But I cover all this, spiders, ETFs. The spider and stock one I do at 9 in the morning. So you're getting 40 charts in each. Plus on the weekend, I cover the weekly charts, all 40 for you. How do you get this? Take advantage of it. These are exciting markets now. It doesn't get more exciting than this, okay? If you're looking for the futures to be more, you're not going to get it. Go to iraepstein.com. Under the word research, all the information is there. Move your cursor up here, give it a click on the icon. That'll take you there. I'm Ira. I'll see you live next Friday, a week from today. Before then, adios, but I do intend on doing my very best to put up videos. If I can't, you'll just get one of those short videos. Hey, folks, I'm on. I'll be back on Friday, and away we go. You have a good one.